Good day, my name is Adrian Meager and I'm the Chief Investment Officer of OIM Investment Managers. I'm pleased to share our asset allocation positioning for the fourth quarter of 2025, focusing on our multi-asset funds. It's been an eventful quarter with markets responding to shifting interest rate expectations, moderating inflation and a mixed global growth signals. Through it all, our focus remains clear, staying disciplined in how we allocate capital, manage risks with conviction and seeking out the best long-term opportunities to deliver strong, consistent, real returns for our clients. So let's look at domestic asset classes first, and we start with cash. We maintain a negative view on cash as it is unlikely to achieve our target thresholds of CPI plus 3 in a low equity stable fund and CPI plus 4 in a balanced mandate. Our base case remains that the South African Reserve Bank will continue its gradual monetary easing cycle over the next 12 months, with 325 basis points rate cuts anticipated before the end of 2026. Cash continues to serve primarily as a liquidity buffer and as a tactical funding source for high conviction opportunities within our portfolios. Bonds. We retain a constructive stance on nominal bonds and have extended portfolio duration relative to the All Bond Index. Although yields have compressed to approximately 8.8% on the generic 10-year benchmark, valuations remain attractive in both historic and relative terms. We remain negative on inflation-linked bonds, maintaining zero exposure across our multi-asset portfolios, as current yields and inflation break-evens do not offer sufficient compensation for the duration risk. Property. Following the strong rally in listed property index, we have taken profits and reduced our exposure. Our current weight stands at about 2% within the stable mandates and 4% within balanced mandates. While property fundamentals remain supportive, underpinned by the prospect of further SARB rate cuts, the sector's near-term valuation appeal has moderated. Local equity. We remain neutral on domestic equities, where valuations continue to offer a balanced risk-reward profile relative to other asset classes. Equity weights have been maintained across our portfolios. From a sector perspective, we hold an overweight position in industrials, we've reduced exposure to resources, and remain underweight financials relative to the weights in the FTSE JSE capped SWIX All-Share Index. Now let's move across to global asset classes, starting with cash. We remain underweight global cash as the return outlook remains subdued in anticipation of further policy easing across developed markets. While the pace of monetary accommodation may be slower than previously expected, we continue to prefer global equities over both cash and fixed income. Global bonds. We hold a neutral stance on global bonds following the Federal Reserve's 25 basis points rate cut in October, with the market currently pricing in one additional rate cut in December this year. In response, we reduced exposure to shorter dated TIPS and high-yield corporate bonds in the 0 to 5 year segment, reallocating these funds towards international treasuries. We maintain a short duration bias relative to the Bloomberg Global Aggregate Index, reflecting our view that yield risk remains asymmetrically skewed to the upside. Lastly, moving to global equity. We retain a positive outlook on global equities, maintaining our current exposure across both balanced and low equity stable mandates. We continue to prefer developed markets over emerging markets and maintain a structural overweight to the United States relative to its weight in the MSCI World Index. This reflects our conviction in the superior earnings resilience, balance sheet strength, and innovation leadership of US corporates, particularly within the technology and healthcare sectors. In summary, we maintain conviction in nominal bonds and developed market equities while remaining cautious on cash and inflation-linked bonds. Locally, attractive yields support our positive stance on nominal bonds with neutral equity positioning and selective equity exposure. Property weights have been trimmed post-rally. Internationally, we favor developed markets, particularly the US, over emerging markets and bonds. Portfolios remain positioned for moderate growth, emphasizing diversification, valuation discipline, and real return potential. Asset allocation remains a primary driver of portfolio performance and risk-adjusted returns. Our strategic asset allocation framework is reviewed quarterly, incorporating both top-down macroeconomic analysis and bottom-up valuation metrics. Adjustments to model portfolios and multi-asset funds are implemented following each review, ensuring alignment with our consolidated house view and long-term investment objectives. We remain disciplined in the application of our investment philosophy, anchored in valuation awareness, risk diversification, and consistent execution. And we will continue to manage client portfolios in accordance with these principles. Thank you and take care.